Good morning! Tax Tip Tuesday, 50 out of 52. So today I'm talking to you about inheritance tax, lifetime gifts. So more and more families are being pushed into the inheritance tax bracket, so this is an area of concern for many people. It's a highly complex area, which is precisely the reason why planning is so important. To get you started, here's a brief overview of the gifts that you can make during your lifetime to reduce your estate. So we have the annual exemption. Everyone can give away up to £3,000 worth of gifts. This can be to one person or split between several people. If you don't use your annual exemption in any tax year, it can be carried forward. However, it can only be carried forward for 1 year. And any gifts made in that tax year must use the current year's exemption first. So an example, I didn't give anything away in the 20 to 21 tax year, but in 21 to 22 I give £5,000 away. The 21 to 22 annual exemption is used first, and then £2,000 of the brought forward annual exemption from 2021. So £1,000 of the 20 to 21 brought forward annual exemption is wasted. We then have the small gift allowance, which means you can give gifts worth £250 per person to as many people as you like each tax year. This cannot be given in addition to other allowances made to the same person. We then have weddings and civil partnerships. So in each tax year, a person can give a tax-free gift to someone who is getting married or entering into a civil partnership. The amount that you can give depends on your relationship to the person. So you can give £5,000 to your child, £2,500 to your grandchildren, and £1,000 to anyone else. Sorry, the £2,500 can also be given to great-grandchildren as well as grandchildren. Yep, and then £1,000 to anyone else. So these gifts can be combined with any other allowance with the exception of the small gift exemption. We then have regular expenditure out of income. You can make regular gifts out of your excess ordinary income. The gifts cannot come from your capital though, so they can't come from savings, etc. Now, the name of this is fairly self-explanatory, regular expenditure out of income. The gifts must be regular and they must be covered by your normal income and must not impact on your standard of living. They can't be made out of your capital, and exceptional gifts like a new car or a round-the-world cruise do not count as regular living expenses. There must be an intention here for the gifts to be regular. So even if you only make one gift and then you die, it would be tax-free if you had intended to carry on making the payments. So with things like this, it's always a good idea to put it in writing just in case. Again, these can be combined with any other allowance with the exception of the small gift exemption. So then, gifts outside of these exemptions may be subject to inheritance tax if you die within 7 years of making the gift. However, gifts made within 3 to 7 years of your death will receive taper relief on a sliding scale. Now, over my years as an accountant, I see that people often know about the 7-year rule, but they don't often know about taper relief. So to give you an idea of the scale, it's dependent on the years since the gift was made. So 0 to 3 years since the gift was made would be 0% taper relief, 40% tax. 3 to 4 years since the gift was made would be 20% taper relief, 32% tax. 4 to 5 years since the gift was made would be 40% taper relief, 24% tax. 5 to 6 years since the gift was made would be 60% taper relief, 16% rate of tax. 6 to 7 years would be 80% taper relief, 8% tax. And 7+ years would be 100% taper relief, meaning 0% tax. These chargeable gifts may be classed as potentially exempt transfer, also known as PET. Any lifetime transfer that does not qualify as a PET will be immediately chargeable to inheritance tax. This is a complicated area, always get advice on this. We're getting into the realms of trusts, etc. here. Now, generally the estate pays any inheritance tax that's due. However, if the gifts within 7 years of your death total more than the nil rate band, then the person who received the gift may be liable to pay the tax. Gifts are set against the nil rate band in chronological order. So another example for you, if my nil rate band is 325,000, which is the standard with no spousal transfers, etc., I give away 150,000 in 2015, I give away another 150,000 in 2020, and then another 150,000 in 2021, but I die in 2022. The first two gifts are covered by the nil rate band. Then the third gift uses the final £20,000 of my nil rate band, meaning 125,000 is taxed at 40%. So the recipient here owes £50,000, the estate is fully taxable. There are a couple of other areas to be aware of. Gifts with reservation of benefit, GWR. If you gift an asset but continue to receive benefit from it, in these instances the asset will remain within your estate, so still be subject to inheritance tax on your death. So an example of that would be a property gifted to your children, but it's a property that you continue to live in. Or you gift a painting, but that painting still hangs above your fireplace until after you die. So in order to avoid GWR rules, you could pay the beneficiary a market value rent. We then have pre-owned asset treatment, POAT. This applies when a person disposes of an asset by either gifting or selling, and then contributes towards the purchase of a new asset from which they receive a benefit. So an example for this one would be you sell your house and give your children the money which they use to buy a new house in their name, but you then live in it. If the asset remains within the person's estate, then POAT does not apply. However, if the asset does not form part of the individual's estate, then POAT will apply. This is a charge to income tax based on the market value of the gift, which is revised every 5 years. Now, this is a very brief overview. There are many, many more rules, exemptions, limits. They all need to be considered. It's just not possible to go over them all here unless I've bored you to death for hours on end. But the moral of Tax Tip Tuesday 50 out of 52 is before you gift, get advice. The points I've made here are just intend to give you a glimpse into the possibilities of inheritance tax and inheritance tax planning. There are many, many pitfalls that may apply along your planning journey. I will go into more on what happens to your estate and the possible reliefs you can get in Tax Tip Tuesday 51 out of 52. Have a fantastic rest of the day, everyone.